Hello students. Today we are going to learn about preparation of financial statement for merchandising and service entities. At the end of accounting cycle, all businesses prepare financial statements, regardless of the type of business. Whether merchandising or service provider, all businesses prepare financial statement. In a very similar way, a merchandising business, however, have a very few slight differences in its income statement and balance sheet. Now, we look at the differences between merchandising and service business. What are the differences between merchandising and services business? Merchandising companies are business entities selling a product and possibly a service for the public. A merchandising business sells goods, for example, clothes, books and many more. Net sales are the revenue generated by the major activities of the business. Usually, cost of goods sold is the major expense in merchandising companies and represent what the seller paid for the inventory it has sold. Normally, merchandising business prepare statement of profit or loss with multiple step form. Okay. Let's see an example of statement of profit or loss with multiple step form. Next is service business. A service business is a company that provides certain professional support to its clients. This task directed to help business, such as consulting, accounting, hospitality and many more. The company will receive service revenue after they provide their services. Normally, no any cost of goods sold or charge. In service business, service companies will prepare statement of profit or loss with single-step form. Okay. Let's look at an example of statement of profit or loss with single-step form. Okay. Now time for us to look at merchandising business transactions. At first, we look at purchases. A business will purchase goods for resale to make a profit. Goods for the resale must always be entered in the purchases account. A business could purchase goods in the following ways: cash purchase and credit purchase. Next is sales. Sales include operations and activities involved in promoting and selling goods. Here are two types of sales of goods, which are cash sales and credit sales. Normally, as a buyer, we will look for discounts. Do you know what is the purpose of the discount? Right. Discounts are given to encourage the purchase or sales. There are two types of discounts, which are trade discounts and cash discounts. Usually a buyer views a cash discount as a purchases discount. Otherwise, a seller views a cash discount as a sales discount. Let us look at each discount one by one. Trade discount is a discount offered by the seller for bulk buying. No record needed for the trade discount. Thus, a buyer or seller records all net amounts after discount are recorded in the subsidiary books of accounting. For example, if you buy 100 to 200 units, the seller will offer you 10% discount on the list price. Otherwise, if buy 201 until 300 units, will get 20% discount. Now we look at an example of working for trade discount. Next is cash discount. Cash discount obtained after payment made within discount period and will be recorded in the account. The discount calculation starts from the date of invoice. This is a credit term which is given in the invoice. For example, you will receive 2% discount if payment made within 10 days from date of invoice. If not, full payment must be made within 30 days of the invoice date, which is credit maturity date. For example, buying goods on credit. amounting Rm 1,500. Credit terms 2/10. And null over 30 days. Payment will be due within 10 days as follows. When you made payment within 10 days, you will get 2% discount, which is Rm 30. So net total that you have to pay is Rm 1,470 rather than Rm 1,500. This is a method how to calculate credit terms. Students, please bear in your mind that the discount calculation starts from the date of invoice. Let's look at purchase returns and allowances. As you know, purchase returns and allowance happens when purchaser may be dissatisfied because goods are damaged or defective of inferior quality, or do not meet specification. Purchase return means return goods for credit if the sale was made on credit, or for a cash refund if the purchase was for cash. Besides that, purchase allowance means purchaser may choose to keep the merchandise if the seller will grant an allowance, where deduction will be made from the purchase price. Sales return happens when customer returns merchandise or goods. Sales returns happens when goods are defective or damaged. For example, if you buy a pair of pants and notice that the stitching is coming apart, so you will expect to return the item for the full refund. Next is sales allowance. Sales allowance is a reduction in price charged by the seller due to problems with goods. For example, items sold did not meet the seller's standards. It means maybe mistakes happens in the number of items shipped, or error in the sale price. Besides all these costs, seller or buyer need to for freight costs, which we call as freight on board or free on board, FOB. There are two types of FOB, which is FOB shipping point and FOB destination. Now let's see who will pay for freight charges. Okay. For FOB shipping point, ownership of the goods passes at shipping point. So, the buyer will go to shipping point and owns the goods. Since buyer already owns the goods at shipping point, so the buyer will pay for freight. Then for FOB destination, ownership of the goods passes at destination. It's show buyer owns the goods at destination. Since seller still owns the goods while being shipped, so the seller pays the freight. Now we move on accounting for inventory. There are two distinctly different that are used in measuring the ending inventory. One is perpetual inventory system, and another one is periodic inventory system. Let us look at each system. For periodic system, no detailed record of inventory is being maintained during the year. An actual physical count of the goods remaining on the hand is required at the end of each period. For perpetual inventory system, involves the maintenance of detailed inventory records in accounting system. Continuous record is maintained on a transaction-by-transaction basis throughout the period. Now we are at the end of chapter accounting cycle. Last subtopic is preparation of financial statement. We need to prepare financial statements for merchandising business. There are three statements which we use for merchandising business. One is statement of profit or loss, or we called as income statement. Second is prepared statement of owner's equity. And final is prepared statement of financial position. For service entities, we just prepare statement of profit or loss and statement of financial position. For lecture, we just show you the sample of financial statements. We will discuss more detail in our tutorial class. See you in Chapter 4. Until then, take care and bye-bye.